Hi, everyone. Welcome to the show. Today we have a very special guest, and that's Francois Rochon. Francois Rochon is the head and the founder and CEO of Giverny Capital out of Montreal, Quebec. Francois has been a compounding machine for many years. The global portfolio, 30 going on 31 years now, has been compounding at a rate of right around 15%. For those 31 years. So if you look at the longevity over time, the total return is right around 6,700%. And if you ever open up his annual letter, the latest being 2023, you'll see that glorious chart there over time. But it's really not that easy every year for Francois. There's been times where you've had to adapt, Francois, and we'll get into that in the podcast. But thank you very much for being on.
Oh, thank you for inviting me.
So the last time we met, I was in the old office in old Montreal, but you've since moved. It sounds like in 2018. Why the move?
We needed larger offices, and we probably wanted to be more downtown. So we're kind of the frontier between downtown and Montreal on Square Victoria. So, and it's probably 50% larger in terms of square feet than we had the old Montreal building.
So it's the best of both worlds, right? And now more real estate for the paintings that you hang up on your wall, right? If people ever go visit, Francois, you are an art aficionado. Tell us more about that. How did you become interested in art?
Oh, it was many years ago. I was probably 18 years old. I went to Paris. Never set foot in a museum before. So I went to the Louvre and then to the Musée d'Orsay, and it was really there I discovered the Impressionist masters like Claude Monet and Auguste Renoir and Edgar Degas. And I really fell in love with art. And a few years later, I went to Giverny, where Claude Monet had his house and garden and water lilies that he painted the last 40 years of his life. And I really loved that place. I thought it was kind of an homage to beauty. And I said to myself, well, I'd love to build something like that in Quebec, a kind of museum of the art of our time, surrounded by beautiful gardens and flowers and water lilies and willow trees. And so I decided that first, obviously, I needed to get rich. So I needed a plan. I just had graduated from engineering, so I thought that probably that was not the easiest path to wealth, and I decided to read more about the stock market. And one day I read the annual letters of Warren Buffett, probably beginning of '93, something like that, and it really hit a chord to me. It made a lot of sense, and I became a big fan. I'd read everything about Warren Buffett and also all the other great investors like Peter Lynch and Ben Graham and Phil Fisher. And I got very passionate about finding great companies at attractive prices in the stock market. So I started to manage my own money, kind of a little family fund with my mother, and had good results. And after a few years, I left the engineering career and went into investing. And in 1998, so 26 years ago, started Giverny Capital. So, and the idea was very simple: is to buy for clients what I was buying for my own portfolio. So everyone would be modeled on my own portfolio. Everyone will be in the same boat, and one strategy, one approach, and then a common, very long-term horizon.
And the rest is history, right? You're among very few fund managers who are managing money who are still doing it 31 years in. If you look worldwide, right, that track record is phenomenal. Not only that, but the returns that you've earned. Going back to artwork, every annual letter you feature one piece of art in the annual letter itself. Have you selected the one for 2024 yet?
Oh, no, that's an interesting question. Usually it's when I start to write the annual letter and I kind of see a theme, I like to select a work of art that really matches the theme. So, well, we'll see. I haven't figured that out yet.
Yeah. It'll come, I'm sure. And you also make mention time and time again that you really see your clients as what you call partners. Tell me more about that philosophy.
Well, I borrowed that from Warren Buffett, of course. So when he writes the Berkshire annual letters, he always talk about his partners, and they really are because they're shareholders of Berkshire. But at Giverny, I like to think that we're partners too, because it's not a shareholding structure, but we're in the same securities. We're partners in the same companies that we purchase. So and it's also the way we want to look at clients really as partners. And we want to build something for the next decades. And we want them to really share our investment philosophy. And we treat them as we'd like to be treated if, we were in their shoes. So I think using that label, I think really translate a culture that we think is very important as Giverny Capital.
And maybe though that's a similarity, but maybe a difference in comparison to Buffett is that you rarely have cash on the sidelines. Is that right? You've said that your mantra is that you can never predict the market, the direction. So most often you are fully 100% invested. Can you tell us more?
Yes, when I started to invest in 93, I started all the great money managers. Well, the one that I thought were great. So Warren Buffett, of course, and Phil Fisher, and Ben Graham, Peter Lynch, also John Templeton. And they all had different portfolios, but I would say they share two main things. They look at stocks as part ownership of companies. And also, they didn't think that the stock market could be timed, could be predicted. So they never tried to predict the stock market. So perhaps at some point, Warren Buffett, like he has today, a lot of cash in Berkshire. I don't think it's really because he wants to time the market as a lack perhaps of opportunities. Of course, with close to $1 trillion of assets at Berkshire, it's a larger group of assets that he has to manage, so it limits probably the opportunities. But I really think that he still think that he cannot predict the stock market. So from day one, I realized that that was an important characteristic of great investors. So said, well, I will never try to predict the market. And one way you do that, I think, is to force yourself to be always 100% invested in the stock market. And the great thing is with the market, there's always opportunities. And when you look everywhere in all kind of situation, I don't remember a time that there was no opportunity. There's always opportunities. Of course, when you don't have 1 trillion, it's a little easier to find opportunities. So I think that's one little advantage we have over Berkshire. But and we're still pretty small, so we have 4 billion of assets under management. So I think our opportunities are still numerous.
And when one looks at your newsletter, and any year from 1993 until the current year, they'll see every single yearly return. What I found interesting is that if we look at drawdowns, and of course being in the market 100% invested, that's inevitable, right? As you said, you can't time the market. The biggest drawdown year was 2022, very recently. There's no other year bigger. I think it was around 15%. I think what came close was, I believe, 2007, the great financial crisis. What happened in 2022, Francois, that was different?
Yeah, that was a tough year. I think two of our securities, if I remember well, I think CarMax and Meta had tough years. So that impacted us. But, really, I think the worst year in terms of return was probably 2008. It's not really seen because we put our returns in Canadian dollar, but we had a huge gain of the currency in 2008. But probably without it, we would have been down close to 28%. So probably worse than 2022. So I consider 2008 not just for us, but it was a tough year for many equity investors. But I think it's inevitable. If you invest in the stock market and you're 100% invested, you'll have 20% down years. That will happen. Why it didn't happen more often is probably the right question. So
exactly, and that goes to your risk discipline, right? And always picking above average companies that can
yeah,
weather
we
these
tried,
storms.
but you can be right on the companies and be very prudent and still have down years.
Yeah.
So
So the past 10 years, the theme has really been, from FANG to now the Mag 7. I believe you still own two of the Mag 7. Is that right? That would be Meta and Alphabet.
yeah, exactly.
And the reason for owning those two of the seven, is that still driven? Was that driven by valuation alone? The valuation just made the most sense out of the seven.
Yeah, I think so. I've always been a fan of Microsoft, and we owned it for a few years in the early 2000s, and I thought it was a mistake to sell it because it has done very well. So I always thought very highly of Microsoft and very, very highly of Amazon. And sadly, I've been a fan of Amazon since almost day one. And I came close to purchase, I think, 10 years ago, but I never really purchased shares. So that's a big mistake. But you're right. Being educated as a value investor, it's very hard to stretch yourself at paying P's in the high 30s and 40s and even 50s sometimes. So, but you'll miss some opportunity because some outstanding companies are really worth 40 or 50 times earnings, but they're very rare. And we have to be, and always come back to reading Ben Graham, and he always stretch importance of margin of safety. So when you pay 40 times earnings P, well, margin of safety is pretty slim, but sometimes it is warranted. And I believe in the case of Amazon, all those years, it was warranted, and it was a mistake not to purchase it, considering that I really understood the moat and the strength of the company.
But it just goes back to your discipline, right? You're not always chasing what's hot on the street. But other portfolio managers, that's their pitfall, where they're chasing the index. And you introduced this term, I believe you called it the index waltz. Can you talk about the index waltz?
Well, it's the second time I've experienced that, mostly as an observer. And it's really what happens is a few big holdings in the S&P 500 do very well. Let's say Amazon and Apple and Microsoft and Nvidia more recently. And they do very, very well for good reasons. But at some point, it gets a little pricey. But they continue to do very well, and they become large weight in the index. And all the managers that don't have those securities in the portfolio, they'll underperform. And by underperforming, they'll lose some clients that will want to favor the index, which has beaten most managers in the recent years. And they'll continue by just going in indexing. They'll continue to purchase a large weight in the index. And here is the waltz. The more they buy the index, the more the large weight goes up. And the more they goes up, the many more managers underperform and lose clients to indexing. So it can last quite a long while. And it has in the last few years. And it really resembles the early 2000s. There were different names back then, like Cisco System or General Electric. But it's similar in the way that the process is going on. And if you go back to 2000, I mean, Cisco System was an extraordinary company, and we owned it for a while, I think from 97 to 99. And but at some point, I think the height of 2000, the stock traded at 80 times earnings. And if you look at the stock today, I'm not sure it's even gone back to the peak of 2000, because today the P ratio is probably 14 or 15 times. And it's been a great company. Cisco is an outstanding company, and they probably grow grew their earnings by, I don't know, 9 or 10% a year, which is very good over 20 odd years. But the P ratio was so high that it limited the upside. And in this case, it turned out that it was, a low return for many decades. So there's a danger of overpaying for even the greatest companies. And the law of large numbers make it at some point that when you're up to 1 trillion of market cap, it's much harder to compound at 15% per year. I mean, you need another trillion of market cap addition in the next 5 years to justify 15% growth. Yeah. So when it trades at 30, 35, 40 times earnings, I mean, the street expects high growth rate. And at some point, it's going to be just impossible to continue at those high rates. But so far, they've been incredible performers. So the Waltz has continued.
Mm-hmm. For the viewers to really get into your head, Francois, to understand your framework, how you select companies, I think let's stay on this point of the Mag 7. Do you ever think about, what are the next Mag 7? Does that ever go into your thought process and you're trying to find the next, 8, 9, 10?
I'd love to know what will be the great companies of the next 10 years, but we always have the same process. We look for outstanding companies with what we believe outstanding managers with strong moats, competitive advantage that trades at reasonable valuation. And the size is not really a criteria. You can find such companies at 500 billion of market cap, and you can find them at 500 million. So we really just look for companies that we can own. And that's the key word. We want to act like owners. We don't try to predict, what the market will do, of course, but also what sectors will do well or what trend will be out in the next 10 years or so. We just look for great companies that we'd love to own for the next decade or so. And being prudent on the valuation, what we're trying to aim at is to have at least the same results in our investment when we purchase the stock as the intrinsic performance of the business. So if the company grow their earnings by, let's say, 12, 14% in a year, we'd like to have that return in the stock. So the way to avoid lower return in the stocks than the performance of the business, the only way you can do that is to overpay for the company when you purchase a stock. So by being prudent in the valuation, we want to align the intrinsic performance with the future performance of the stock.
And your assets under management have grown considerably since 1993, and you just made mention that they're right around $4 billion now. Has that changed what you invest in, Francois, in any way? Have you had to go up market? Were you previously maybe buying smaller companies?
Not really, because in the first years, I remember owning Hewlett Packard and Mattel and Berkshire Hathaway has been in the portfolio for a while. So they were already large companies in the portfolio. The first decade was not, the portfolio was not made out of tiny companies that we could not purchase today. There's probably one company in the portfolio that we've owned for, I think, 17 years now that probably would be too small now to purchase is MTY. MTY, I think at
Stanley Ma's MTY Food Group.
Yeah, I think it's a great company, and we purchased it the first time in 2007. And that time we had, 120 million of assets under management, so it was much easier to purchase. But today we could not purchase even a 0.5% new weight in that security because it's not liquid enough. I think that's the only exception. I think all the other companies in the portfolio, were okay at $4 billion. Probably some of them we cannot purchase them in 2 hours, but instead it would take 2 or 3 days. But 2 or 3 days is fine.
What was the inflection point for you, Francois, and the fund from a few $100 million under assets under management to now billions? What was in your mind the key inflection point?
I don't think there was an inflection point. I think it took many years and it went very slowly. So it was one partner at a time, and it's a combination, of course, of the return of the portfolio itself that has compounded, but also getting new clients/partners. And it's been a very slow process. And I think I've been a fan of companies that grow steady, but not necessarily incredibly fast. I'm not a fan of companies that grow at 200% a year, because it's hard to maintain, it's hard to sustain, and you have to build a structure before revenues come in, and it's a little more risky business model, I believe. So I like it when it's very steady and there's no inflection point and there's no big thing that does change everything. It really is just to do it the same thing every day for 30 years.
That's just amazing. In 2002, the story goes, you were going to fly down to Omaha to your first, I believe it was your first Berkshire Hathaway meeting.
Yeah, the first was 1999.
1999.
Yeah.
But then, so in 2002, it was your first time, I think, meeting Charlie Munger.
Yes.
You had made a pit stop at the West Coast shareholder meeting, is that right? In
Exactly.
California?
Yeah.
Tell us about that first meeting with Charlie.
Well, it was not a very long meeting. I think it was he was introduced by Bob Miles. So I'm a good friend with Bob Miles, and we went together to the West Coast meeting in Pasadena. And Bob introduced me to Lou Simpson and Charlie Munger, and just talk a few minutes. But that was a great meeting. And in those days, I don't remember, but there was probably 300 or 400 people at that meeting, so it was not as crowded as the last ones of Wesco or the Daily Journal in the last years. So it was a very intimate meeting and very fun. And Munger has been a great teacher, and he's very he was, because as you know he passed away, but he was a great teacher, and he'd love to preach the gospel of integrity and long-term thinking and building something that lasts. He had great values, and I think it was kind of a beacon in our time.
Yeah, he absolutely was. I always recommend the book, Poor Charlie's Almanac, to anyone who wants to learn more about investing. It's a phenomenal book. I think it was just updated, I believe, this year.
Fantastic book, yeah.
What's your favorite Mungerism, Francois?
Well, I think in the last annual letter I wrote, if you're not ready to go through a 50% drop in the stock market, you're not worthy being an equity investor, and you'll deserve the poor results you'll get. That's funny, and that's very true.
It's so true. It's earned, isn't it? The magic of long-term compounding.
Yeah, I think that's another Mungerism, that in the end, the best way to get what you want is to deserve it. And I think that's a very simple statement, but very profound.
Yeah, that's phenomenal. So this is kind of going back to your previous point, but I think let's explore this more. In each annual letter, there's a section, and in that section, there's a table, owner's earnings. Why do you put the owner's earnings table in each annual letter?
Well, it is for me, of course, to follow what's happening to the companies we own. So the idea is very simple. We want, like I said, we want to measure we want to compare the performance of the portfolio to the intrinsic performance of the holdings in the portfolio. So very simply, what we do, we add all the earnings per share of the companies we own, multiplied by the number of shares in the portfolio, and we get a total earnings, which we call owner's earnings, because it belongs to the owners. And we compare that to the previous year, so we get an increase. We could call the intrinsic value increase of the year. So let's say earnings for all the portfolio is up 12% a year, and then we'll compare it with the performance of the portfolio. And if it's less than 12%, it means that probably our portfolio is undervalued. And if it's more than 12%, perhaps our portfolio has either rectified a past undervaluation, or it is a little in advance of what would be warranted. And when you look at that table, and I started that table in 1996, so is 27 years or so, 28 years or so of data. It's really incredible if you take 1 year randomly, there's a big difference. Most years, there's a big difference between the intrinsic performance of the portfolio and the market performance. But if you take the whole years since 1996, it's incredible the correlation there is. And I think, I don't remember the exact number, but I think the intrinsic value has increased at 12.5% a year, and the market performance of the portfolio before fees or taxes or anything, but gross return has been something like 12.6%. So it's very, very close. And that's the objective. That's what we want. We all want to own great companies. And if we're right on the companies, eventually the stock will just reflect the increased intrinsic value of all the companies in the portfolio. But it's important for us to measure objectively how our companies are doing. And I think also it's important for the partners to understand what we're trying to do and how we judge the performance of the portfolio. Not only the market performance or relative to the index, but also how our companies have done intrinsically.
And that's why so many of your partners trust you, and you're gaining more partners yearly. And it's a really important lesson for young investors who, might enter the stock market, download Robinhood, and just start buying meme stocks that have no earnings. Really long-term success, compounding success comes down to what you said, the simple reality that earnings drive share price performance and shareholder value over time. What will be, do you think, have you determined this, the flavor of the day for 2024?
I haven't think about it yet. I usually work those letters in January. We have the end of the year gives us a little more perspective. It's hard to tell, but I think there's many things that are dangerous, of course, these days. First and foremost, I think the return of Bitcoin this year's, I think is gonna left a lot of people, I don't know when, but poorer at some point. And I think that's probably where there is more excess, but it's already been the flavor of the day some years ago. So I like to be more original, but that's probably the most dangerous part of the investment. Well, I don't exactly remember the total amount invested in Bitcoin or similarities. I think it's $3 trillion. That's kind of, started to be a lot of money. So if there's 1 or 2 trillion that is lost there, it could have some impact on the economy. So I think there's no way we can do something about protecting ourselves besides just stay away from it.
I think Trump hasn't helped at all because he's only helping to pump the price of Bitcoin, isn't he, with his support leading up to the election. So you're more on the side, it sounds like, Francois, that Bitcoin is more of tulip mania than it is the next gold.
That's my opinion, but I'm not very original because I've just copied what Warren and Charlie have said in the last decade or so. But I think they're right.
Well, if we look in your global portfolio, Francois, what are the longest running companies that you've held the longest amount of time, if you're to pick 1, 2, or 3?
Well, there's, of course, Berkshire. That's been in portfolio since 2000. I don't know if you remember that, but in March 2000, at the height of the tech bubble, Warren Buffett was seen as an has-been, and you could purchase Berkshire below book value. So that was the first time I took a big position.
That was a gift.
Yeah, that went well. There's probably Dollarama that's been in portfolio since 2000. I think it's early 2010 or end of 2009. So we're talking 15 years here. And like I said, MTY, it's been in the portfolio for 17 years. Visa was purchased, I think, in 2010. So that's been in the portfolio for almost 15 years. Google, now Alphabet, was purchased in 2011, so 14 years there. Bank OZK, a small bank in Little Rock, Arkansas. I think the first time I purchased it was in 2006. So it's probably one of the oldest holding in the portfolio. And M&T Bank, I bought and sold it a few times. But the first time I purchased it was in 1998. So that's quite a long time ago. And same thing with Progressive. I bought Progressive the first time in 1999. They had just started to sell insurance online, and Wall Street was very skeptical that they would make money out of that new way of distributing insurance. They lost money at first, but in the end, it was a good decision. And so we purchased a Progressive in 1999. I think we sold it in 2005, and then repurchased again in 2019, so 14 years later. So now it's been a portfolio for 5 years, a little more than 5 years.
So this is an interesting thread then. So which goes into your selling philosophy. Why did you sell Progressive in 2005?
It was a combination of things. It seems to me that the company is kind of the growth rate had plateaued, and it was slowing. And I think it was really a new management team that rekindled the growth rate, and they had, I think, the brilliant idea of combining car and home insurance to what they call Robinson, so typical prudent family. And it's been, I think, under the new management, it's been a very, very strong company.
And I'd love to know your thesis around Dollarama, Francois, because you mentioned you started buying around 2009, which I believe was when it IPO'd. And not only that, is that at the time, a lot of people would have said, Francois, like, isn't Dollarama saturated? How much more can they grow? So tell me about your thought process. Like, it was almost, in hindsight, it's genius in hindsight, but at the time, it was taking a chance.
Well, I remember I knew Dollarama before it went public, and I knew how great Larry Rossi is, and I was very disappointed when it did not come public. It was sold to a private equity. I don't remember. I think it was Bain Capital.
Bain Capital?
Yeah, exactly. So we were disappointed because we wanted, of course, to become shareholders. We thought very highly of the business and the management. And then a few years later, probably 5 or 6 years later, they took the company public. It had a little more leverage than probably we would have liked, but we said, well, it's fine. Well, we have confidence that the management will reimburse the debt and the leverage will be reduced. And I remember, I think we paid 18 times earnings. And, in 2009/10, that was a very high P because you could buy great companies at 12 times earnings at that time. So we said, well, okay, it's a little pricey, but, we'll jump anyway. So we invested, not exactly at the IPO, but not long after it became a public company. So I thought that was the best management in the retail industry. And we've been owning the companies for all those years, and sadly trimmed it a few times. So because it would be a much larger weight than it is in the portfolio today. So I made that stupid mistake. And the thing is, when we talk to other retailers that are in what we call it small prices items, it's incredible when you talk to a British company and they use Dollarama as a model, as an example of what they would like to achieve. So this is not only a great Canadian company, that's a worldwide leader model to many other retailers. So it's a fantastic company.
Completely agree. I think Dollarama is almost like the Canadian Costco, not in the same business model, but it's that pinnacle, as you said, of retail, right, for our country. Dollarama being based in Quebec, and I think maybe MTY is or was based in Quebec. Is there something about Quebec companies, if we look at the Canadian market, that makes them like special, and why?
Not necessarily. I don't think there's per capita more great companies in Quebec than in Canada or, of course, the U.S. You're just trying to find the best ones. And, Constellation Software is the largest weight in the portfolio. It's a Toronto-based company, and think very highly of Mark Leonard. So I don't think there's anything special in the water of Quebec. So.
I had to ask. So, unlike a lot of other money managers, you are completely transparent, and you can find this in your annual letters. Again, you have a section there titled Podium of Errors, and you discuss what didn't go as planned in terms of stock performance. When companies don't go as planned, are there commonalities, Francois, as to why they just don't work out?
No, I think every mistake has its own story. Things that don't work out, there's many reasons. And it's a tough world. It's a competitive world. And that's a great thing about capitalism. It brings us progress and great products. But that's because it's very competitive. And, there's always someone that tries to do it better than your company. So, of course, you'll have companies that are going to be left behind at some point. So it's almost inevitable. But the biggest mistakes by far is the companies, like I said, like Dollarama, that I trimmed for, I don't know what could be a logical reason other than temporary insanity. But it's the really great companies you did not purchase for some reason, because probably you thought the P was a little high. And we almost made that mistake with Dollarama at first. So when you missed a company that goes up 1,000%, it's much more costly than when you purchase a company the stock goes down 50%, and much more. It's not 2-to-1, it's 10-to-1. So the big mistakes is really just you found a company that fits your criteria and didn't purchase it for some reason that can be a combination of valuation or some fears that you have of competitors, sort of thing like that. So, but the big mistakes are the omission.
The omission, as Buffett would say, the error of omission. And you mentioned Amazon being one.
Oh, yes.
And I think another one that you've written about is Novo Nordisk. And how do you feel about Novo Nordisk today?
I think it's probably the greatest pharmaceutical company in the world. And, I met them 10 years ago. I already knew them much more years than that, and never purchased shares. And that was a big mistake. And I think it's a fantastic company. Of course, Ozempic has been a huge success. The valuation is a little demanding, but it's not too bad. So if it could, I should not say that, but if it could go down a little more, it could be a candidate for sure.
It could be an opportunity. And it's interesting you say that because, 10 years ago, they didn't have the Ozempic drug.
It was already the leader in diabetes drugs. So
exactly. So they just continually innovate, which I'm sure makes them such a brilliant company.
Yeah.
Tell us about John Philippe. I think he was hired on, and is he now a co-manager? What would you consider John Philippe?
Jean-Philippe joined in 2002, and he does many things. He wears many hats. He's involved with the management team. So we're really 3 people in Montreal that study companies and analyze, 10Ks and financial reports. And we also have 2 people in New York City that help us. We share ideas and everything. So he's part of that team, but he does much more than that. He's very good. He's a very good people person, much more than me. I'm a book person. I love to read. I love to sit quietly in my library, and I can spend 2 or 3 days without talking to any human being, and I'll be fine. But JP is really a people person. He loves to talk to analysts and other managers and other investors, and he talks about everything about investing in the business world. And by using his I would call people skills, he really gets a lot of good things from other human beings, and he's a nice person, so people like to share with him and talk to him. So it's been very important in the development of the business.
This is great. You mentioned that you love to read, and thanks for taking the 1+ hour with me to talk. Um, what do you like to read daily to stay up to date on the markets, on companies, Francois?
Well, I read about many things, not just investing on the markets, but I look at Chinese companies, I look at Australian companies, French companies, British companies. I like to read about all sorts of companies, sometimes even companies that we won't invest because, like, for example, South Korea is a little complicated to invest or you have to open an account there. And so we never really bought the company from the Seoul stock market. But I'll look at some companies there just because I want to know about them. And I like to read history, like all the old computer companies from the 50s, 60s, 70s. I mean, if you read about the story of Compaq Computer or Hewlett Packard or Commodore, that were one of the first companies to produce personal computer, or old video game companies like Atari and television, it's fascinating. And it's always fascinating to find a old magazine of Forbes or Value Line and look at all those companies that are talked about that don't exist anymore, that you've even never heard of. And it's really striking. It shows how much capitalism works fast to destroy many companies. So by having that, I would say, long-term perspective, historical perspective, I think it makes me more prudent and more humble about the companies we think today are fantastic and great and we believe can last for decades. And we realize that some companies in the portfolio today probably won't be around in 30 years. So we have to accept that. Then, in fact, one of the first great company in the portfolio was Sun Microsystem. And it was purchased, I think, by Oracle at some point, but it really doesn't exist anymore. And, at some point it was one of the top computer company in the world. And we had a very good return on it. I don't remember exactly, but we probably made 5 to 10 times our money in that investment. So you can have good results for a while, but you have to accept that you always have to be careful and study things and, remember that things can change, sometimes for the best, but sometimes for the worse. And humility, I think, is very important when you look at companies.
Did you make any new additions to the global portfolio this year, 2024, Francois?
Sorry?
Did you add any new companies to the global portfolio this year?
Yeah, we probably had 2 or 3 names, and we'll discuss it in the annual letter. But yeah, we added not many, and I would say it's similar to any typical years. Probably out of, let's say, 25 names, we probably add 2 or 3 every year. So we subtract 2 or 3 and add 2 or 3. So that turns out to something, I don't know, 12% turnover ratio. So our average holding period is probably 8 years. So we don't do a lot of trades.
Going back to your point about the rapid rate of change and it becoming more exponential, do you find that the turnover rate increases every 5 years? Is it different from when you first started in 1993 and let's say the first 10 years?
No, I would say I trade less than I used to. I'm more patient than I used to. And I also realized after many, many mistakes that the key thing when you manage portfolio is to hold on to your winners. So probably decreases the turnover ratio when you just hold on to a few outstanding company, even if they look a little pricey at some point. And that was a mistake I did with O'Reilly. We sold it probably 5 years ago, and that was a huge mistake. And it looked a little pricey at the time, but the performance has been incredible with this company. And we made probably 10 times our money from 2004 to 2019. But if we have kept it, probably we would have added a 3 or 4 time ratio increase. So probably in the end, something 30 to 40 times our initial investment. So it was an incredible mistake. So learning from those mistakes, I probably hold on to the companies more than I used to.
Yeah, for you, you're always weighing opportunity cost. Could that capital be deployed out of O'Reilly into a company that you think you project
Yeah.
could be growing faster? Well, what was the reason for selling O'Reilly?
I thought that the growth rate would slow, and the valuation was probably on the high side. When I purchased it the first time, I probably paid 15 or 16 times earnings, and at some point it reaches the high 20s, and I thought that was and the growth rate was slowing, so I thought that it would make sense to allocate capital elsewhere, but the growth rate returned to a higher level, and the valuation stayed the same. So it was a mistake in the end.
Would you describe your portfolio, your global portfolio, as a concentrated portfolio?
Well, it's not as concentrated as some other investors like Warren Buffett or Glenn Greenberg, for instance. So sometimes they have less than 10 names or close to. Probably we're more diversified, having, perhaps 25 names on average. But 25 names, I think it's still concentrated enough. So what you're looking for is kind of a balance. You want it to be diversified enough so that, you reduce the risk of, one big mistake costing you a large chunk of your capital. And at the same time, you want to be concentrated enough so you'll have, some odds of beating the market. So I don't know what's the right amount of stocks, but to me, 25 seems like a good balance.
Was 25 always that magic number, Francois, like right when you started out, or was that come through a learning process?
Yeah, probably. Perhaps a little more concentrated in the first years, but I think I always had at least 29s. So it can be 25, can be 28, can be 22, but around 25.
Tell me what you look for in CEOs, because you've made mention right now that, for example, selling Progressive didn't look like you're too happy about the management team in 2005. Rebuying it is because of the new management team going back in a growth trajectory. What else do you look for in management teams of companies?
Of course, there's many little things. There's a little bit of subjectivity. Is my opinion on the quality of the person in front of me. But we'll look at the way they rewards themselves, the salaries that are paid, the stock options, how they react when their stock go down, and the language also when they have some difficulties, because almost every company will encounter difficulties. It's many, many little things. When we started Constellation Software, one thing that was incredibly striking is Mark Leonard has no salary, and he had, I don't remember, I think 20% of the shares of the companies. So of course, that's the ideal situation, because he has no stock options, he doesn't pay any bonuses. Sorry. And he's in the same boat as we are, because he owns a lot of stock. I remember many years ago, Bob Curling at Fastenal, I think his salary was $106,000 a year, and he had 20% or so of the company, and it was an incredible CEO. I mean, it was really something else. And I remember Fastenal had no stock options, so you would look at the last 10 annual results of a company, and the number of shares outstanding were exactly the same to one share. It was fascinating to read that, because you see all those companies that dilute every year. And I remember at some point, I don't know exactly what year, but I think there was some pressure from high managers to issue shares to employees. And what he did, he used his own shares to give to employees, because he didn't want the other shareholders to be diluted. So that's probably the only time in history of capitalism that has happened. And Bob Curling was a great man and a great CEO. So he's kind of the model I always look for, and hoping I'll find another one day.
One of a kind, right? To use your own shares, because you don't want to dilute existing shareholders. And I believe we look at Constellation Software, another example you brought up. 21 million shares on the balance sheet has remained the same since day one, I believe,
Yeah,
right?
I think so.
Right.
Yeah, he's really something else. Mark Leonard is probably the closest one to the greatest manager I've seen, of at least in the last 10 years, that's for sure.
When was the last time that you met Mark Leonard?
The last time was probably, I would say 2 years ago. I met him a couple of times, but last time I was hanging out in 2022.
And his philosophy has not changed. He's
Oh,
still
no.
on the same
No.
course.
Oh, yeah. No worry there.
When did you first discover Constellation, and how? How did you? What was the discovery process?
Oh, yes, I remember it very, very clearly. It was December 24th, 2013. So I was at a Christmas party, a friend, and his son, but not very old, probably
Damien?
21, 22 years old. And the son of the friend
Okay.
asked me if I knew Constellation Software. I never heard the name, so I was a little pissed off that this young kid would know something I did not know. So as I was very, I was in an urgency to go back to my house and read the annual report of Constellation, which I did the New Year, Christmas Eve. So I read the annual report of 2000, probably it was 2012, so the previous one. And I thought that was a fantastic annual report. And probably bought shares a few months later. So we started to do our due diligence and research and reading the 2013 annual report, of course, when it came out probably in February, sometime like that, 2014. And we purchased shares. And we, contrary to O'Reilly and Dollarama, we never really sold many shares. We have this rule that when one stock become more than 10% of the portfolio, we'll trim it a little bit just to get it back at 10%. But beside that, we never sold shares of Constellation. But we had to trim at some point because it has done so well.
And that's been incredibly smart, obviously.
Yeah. So
the question is when, right? When do you?
Yeah.
When do
So
you
I'm
trim
still
and
a
why?
friend with that young investor that is now a brilliant businessman on his own, and always thinking about sharing his idea of Constellation.
That's really interesting, and it just shows how humble you remain, Francois. Right? Because someone like Peter Lynch in his book probably wrote, "Never get a stock tip at a cocktail party, right? And buy it." But you literally did just that after research and due diligence. Are there any other interesting, unconventional ways that you happen to discover companies that you ultimately invested in?
Probably there is. Just nothing comes up top of my head just now. But there's, that's a great thing when you love what you're doing. When it's not work, you always are interested in learning about companies and all sorts of situations. So I always say that wherever I go, I always have my capitalist antenna on the top of my head and always on the lookout of, finding a new company or hearing about an interesting business. So, and when you love what you do, it's almost natural. So it's not work, it's not research, just, you're interested. It's like you love hockey and you watch 3 or 4 hockey game every day because you just enjoy it. And when suddenly a new player comes along, like Connor McDavid, well, I say, well, this guy has a future.
Yeah, exactly. Or art in your case, right? You're super passionate about art. We understand that. The painting behind you, I think we were talking before the show. You mentioned you acquired that about 4 years ago. Can you tell us a little bit about that painting itself?
Yeah, it's a Neo Rau. He's a painter from Leipzig in Germany. And he's been painting for at least 30 years. He's well, I love many artists, of course, but he's a very fascinating painter, and his subjects are really mysterious. And when he was young, he was still in what was called the RDA, the République Démocratique Allemande, so the East German part before reunification. So it was a communist country, and it has influenced, I think, his painting. He was educated as a neo-realistic painter, and he does things today that are kind of very hard to put in what era of humanity this image comes from. So, and it's very, when you study his work, and there's many books published on his art, when you study his work, it's a very, very interesting take on human history.
That's really interesting. What art galleries are on your list that you want to travel to, or museums, but you just haven't gotten around to it, but you're planning to?
Well, I've been to many museums, of course, through my many visits. There's a few of them I have not gone yet. Probably the one, I've never been to countries like Norway or Finland or Sweden. So there's great museums there. So that's probably the next one on my list.
Interesting. Can we?
I'm not a fan. I was born in the wrong country. I'm not a fan of cold. So I much more enjoy going to Italy than going to Norway. But there's great museums in Norway too. So
Yeah,
I should go.
Going from a cold country to another cold country isn't on your list.
Yeah, but perhaps I can go in the summers.
Can we talk about your outlook for 2025? How you feel the market will play out?
But I don't have much outlook so to share because I don't have any idea what the market will do. I think in general these days, there's kind of two worlds. What they call the Magnificent Seven, and there's the rest, the many other thousands of companies, and it's really feel like two worlds. So those seven have done well, and for good reasons, because their intrinsic performance has been really outstanding. I mean, it's unbelievable when you look at the results of NVIDIA this year. I mean, they're growing at 100%, and they are already in the $1 trillion market cap. So I don't think in history such a large company has grown at those kind of growth rates. So it's unbelievable. So not only are they great companies, but they've continued to grow at very high ratios. And they're almost like an anomaly in the history of capitalism, because usually if you look at past history, the large companies of the S&P 500 or Dow Jones Industrial Average, usually they grow at the average, which is 7 or 8% a year, but not 15 or 20%. Not those large companies. Usually that was the smaller companies that are growing at larger growth rate. So so those seven companies now of course are growing fast, but the P ratio are much higher than the other companies in the S&P 500, for instance. I don't have the numbers on the top of my head, but I would say that probably the top four, which is what Apple, Microsoft, Amazon, and NVIDIA, probably their P ratio is in the high 30s, so let's say 35, 36 times earnings. And the rest, all the other companies in the S&P 500, probably it's 18 or 19 times. So 18, 19 times is reasonable, is really similar to past valuation for the S&P 500. But the other ones are much higher than historical norms, which makes the P ratio of the whole S&P 500, when you combine the both parts, probably 23, 24 times, which is on the very high side of historical valuation. But again, it's just few names, 4 out of, I think there's 503 companies in the S&P 500. So there's 4 really that are higher P ratios that makes the whole S&P 500 looks like a little pricey on the high, well, at least on the high side of valuation. And historically, when valuation was high for the S&P 500, the next 5 years or so, the returns were usually lower. So, but again, this is such a different story than it was in the past. If those 4 companies continue to grow at 14, 15, 20% a year, it's very hard to know what will happen. So perhaps the P ratio will stay that high for a while. So, but if there's a normalization to lower growth rate, 8 or 9% at some point, well, probably their valuation will go down and the whole index probably will be impacted, but because of those large weight and those four names. So I think it's going to be very interesting. So if there's some kind of normalization to past performance, I mean lower growth rate for large companies and a reduction in the P ratio of those great companies, well, those it would impact the S&P 500. But if you're invested in other securities than those that are expensive and you pay 16 or 17 or 18 times, probably you will be less impacted. So we'll see. But it's a period that really doesn't resemble any other one in the past. So it's very hard to see what could happen in the next few years.
So why could it be different this time, Francois? Like this small cluster of very large companies continually growing and outperforming others. What could be different?
I'm not saying it's going to be different this time because that's the most dangerous sentence in investing, John Templeton said many years ago. So I think it's just the nature of the economic world that at some point those companies won't be able to grow 20% a year or 15% a year because they're so big at some point. I don't know when it's going to reach that point, but it's very hard to believe that all those companies will double their earnings in the next 5 years. Perhaps it'll do it for 1 or 2 or 3 years more, but at some point, their large level of revenues and profits, they'll just the law of large numbers will slow the growth rate. Then, if you look at Apple, the growth rate has slowed. They really have been helped by the services part of the business that's growing very fast. But if you just look at the hardware part of Apple, it's not growing very fast. It's probably 3, 4, 5% a year. So there's a little bit of price increases, but it's not a very strong growth rate. And the P ratio is still in the 30s. So I remember when probably 10 years ago, I think Apple traded at some point was trading at 12, 13, 14 times earnings. So it's a very different situation today. But I still think it's a great company. It's just at some point, it's going to be hard to justify those kind of P ratios.
Now, you also have a Canada-only portfolio. Has not been as long-running as the global portfolio. I believe it's going on 18 years now. But if you look over those 18 years, the compound annual return is higher than the global portfolio. I believe it's hovering around 17%. Do you expect that to continue, Francois, that your Canadian portfolio is even beating the U.S. portfolio? Can you talk about that dynamic?
Well, it's not a different portfolio. We have just one portfolio. It's a global portfolio, and there's a Canadian part of it, and there's a U.S. part of it, and we just segregate the numbers. Just because some partners have asked us the information. They wanted to see how we did in Canada compared with what we did in the U.S. And I remember that when we did it, people were skeptical that our Canadian companies could do well because we did. Yeah. I think we started to do it in 2007. And if you remember back then, almost the only sector that did well in Canada was everything related to energy and oil. And we didn't invest in oil companies. So people were very skeptical that we could do well in Canada. And I said, well, perhaps I can show you the returns of the Canadian part and you'll be able to judge. So but it's not really a portfolio because there's only 4 names in it. So it's not, and I always write it in the annual letter. It's just the Canadian part of the global portfolio. But you're right, and it was mostly Constellation Software and the Dollarama that have done so well in the last decade that has really helped those performance. But 4 stocks is not diversification, so it's not really. I don't consider it a separate portfolio. But we give the numbers because people have asked about it. So
just interesting. It really gets people more interested in the Canadian market, right? Because some might say you can't just invest in Canadian stocks, but if you're a stock picker, like yourself, if you do the research and due diligence, you can absolutely find some great companies here.
Oh, yes, there's many great companies in Canada, and you could probably do well just buying Canadian companies and having a 25 name portfolio. I just think that if you're on the lookout for the greatest companies, you'll probably end up with many of them in the U.S. I mean, Constellation and Dollarama and TY and Lululemon also, which is a Canadian company.
Mm-hmm.
I think they're all great companies, and I'm okay investing with it. But if I would just select a group of, let's say, what I believe are the 50 most beautiful business in the world, probably just I would come up with at least 30 of them that are based in the U.S. And the United States is still the mecca of capitalism. This is where you'll find the greatest companies. This is where you find the greatest entrepreneur spirit. And it has a great culture of encouraging building companies and encourages wealth. In Canada, wealth is not as promoted, I would say, as in the U.S. So I always say that it's the plants that grow faster are the ones that get the most sun and the more water. And I think in Canada, we're not as strong as the American are, and giving good water and good sun to the plants to grow.
Yeah.
But
on this topic, I would love to know your opinion, Francois, on Asia and the quality of companies there and management's attitude towards shareholders.
Well, we did well in Japan. We invested in a Japanese company in, I think, 2007, and it did very well. We owned it for 3 years, and it was a good experience. We've looked at other Japanese companies, and usually what has prevented us is valuation. We've owned a few names in China over the years. Our experience has not been that good yet. I would say probably we own 2 or 3 names, and those 2 or 3 names have not been very rewarding. So it's been a tough experience in China, and there's many different reasons. Some, of governments a little different, but it's a very competitive market. It's different culture than in the U.S. But we're still looking. I mean, if you look at BYD, that the Berkshire invested, I think was in 2007 or 8. I think it was 2008. It has done incredibly well. So there's great companies in China. Probably just need to be a little more prudent because the rules are a little different. You never know when the government will change laws about how companies operate. I remember, I think it was private education. They changed laws at some point, and stocks went down tremendously after those changes. So you have to be very careful. And but that being said, I think there's interesting companies in China. But so far, we've been very, very prudent and timid to invest. But we look at that market.
Is Gen AI, more specifically ChatGPT, does it play a part at all, or are you the analyst experimenting with it in the stock research process, or is there no role, do you see, for Gen AI?
Well, so far we have not really used it for research. Perhaps I don't know. Perhaps the others use it and they have not told me about it. But personally, I don't use that much. For some things I've done, some searches and requests, and but not for investing. And it's probably AI. I think it's probably a great revolution, but it's very hard to say how it will all play out. Who will be the winners? But so far, I think the 2 companies in the portfolio in that world, like Meta and Alphabet, I think so far they took advantage of the growth of artificial intelligence. Of course, it would have been better to own NVIDIA, but Meta, I think it's probably the company that has made most of it in terms of improving their their revenues and better targeting their ads. I think all the billions of dollars invested in AI, I think it's probably the company that has got the most reward of those investments.
Yeah, it goes to show too that investing is much like art, isn't it? There is a lot of intuition involved. It's not just purely science and inputting and outputting numbers and basing your investment decisions on that.
I'm not sure if it's intuition. I think it's really creativity, is to find companies that are trying to do new things, are trying to see things before the others. But when it's new, it's also more risky, because when you invest in PepsiCo or Coke, well, there's not much threat from AI there, and it's basically the same product it was 100 years ago. So things that are new are also more risky, but there's also, if you're right, there's also a lot of potential.
Yeah. Favorite investing book of all time, Francois? What would it be? What would you recommend to the viewers to read?
Oh, it's probably still The Intelligent Investor. I'm not very original, am I?
Would Ben Graham, do you think, if he were alive today and investing, running a fund, would he have the same success, do you think, today as he did then?
Oh, I think so. I mean, Warren always says it's not a question of intellect, or it's really a question of behavior, having the right behavior. And, Ben Graham wrote the book about behavior.
Yeah. And then last question to close out. It's been a great conversation. If you were to pick one investor, alive or dead, to have coffee with, let's say tomorrow, who would it be?
Oh, I think I would have loved. I've been very fortunate. I mean, I met Lou Simpson and Glenn Greenberg and Peter Lynch, and they were all great.
Can you tell us some stories, Francois, from those meetings and some of the memorable
Yeah,
moments?
well, I talked about in the annual letter when we went to Lou Simpson house, and he was such a great person, very generous, and he shared his ideas, and he had lots of wise counsel to us. And we also shared the passion for great wine, which makes a memorable evening. Glenn is also a very nice person. It's very fun to talk stocks with him. We went to Peter Lynch home, I think it was in 2011, so 13 years ago. And the funny thing is, he recommended Apple, and the iPad had just been released, and he thought that was a revolutionary product, and so should have listened a little more carefully. And but probably the one I would have loved to meet is John Templeton. I think John Templeton was a very wise man, very brilliant, and very humble. I think I would really have enjoyed spending an evening with him. So, and he lived in the Bahamas, so we could have been on the beach talking about stocks.
Is there a story about John Templeton where I think it was the advent of the war? I forget when or shortly after, where he was just buying up as many stocks trading under $1 because they had absolutely crashed, right? And then he found early success in that strategy, I believe.
Yeah,
I forget the story.
World War II.
Yeah.
I don't know exactly what year, but I don't know if it's 1939 or a little later. But he purchased all the names on New York Stock Exchange that traded for less than $1, and he did well with that. It showed that he was a contrarian in nature. So, and he always has been. And he invested in Japan much before others, and invested back in the U.S. market. I'm not sure of the year. I think it's probably the end of 70s or early 80s. And he said that it would be a good decade for U.S. stocks, and he was right there. So he was a great investor, but I think more than that, it was a great human being. And that's one good reason you want to spend with an evening with someone.
That'll be a nice coffee chat or sharing some very good wine with, French wine, I'm sure.
Yep.
John Templeton being the contrarian, if he were here today, what do you think that he would be skeptical of today?
That's a very interesting question. I don't know. Probably he would you would look at the Chinese stocks because there's a lot of them that are on very low valuation. There's a lot of pessimism in the country and also from foreigners. So I think you would take a very deep look into many, many Chinese companies, and probably you would be a little prudent in investing in the very high PE stocks in the US. Not all of them, of course, as opportunities, but the ones that are trading a very high ratio, I think it would be very prudent toward them.
Well, Francois, thank you very much for the conversation. I wish you the best day. Thank you.
Oh, thank you.